Hi, I am Melissa Joy, and I'm founder and financial planning at Pearl Planning, and thrilled to be joined today by Alexa Kane and Jay Fradenburg. And we're going to be talking all about retirement readiness. This conversation is appropriate both if you're approaching retirement, you're still mid-career, or you are retired, because we really are talking about trends in retirement, how to stay on top of things, and we hope it will be informative as well as actionable. And I'm so excited to get started. Okay, let me refer to kind of our presentation. Here's us at Pearl Planning. I want to make a note that we have one new team member, a financial planner named Tony Wander. So for all of our clients, she'll be in our next group photo coming soon to a theater near you, but we want to welcome those of you who are Tony's clients who are joining and attending a Pearl Planning webinar. And as I mentioned, I am joined by Alexa Kane, a CFP and CDFA, Jay Fradenburg, an accredited investment fiduciary, both financial advisors here on our team. We'll be sharing information with you today. And what we really want to cover is what is retirement, providing a financial planning perspective, which is not just investing, it's about your goals and your needs throughout retirement. Talking about spending and savings checkpoints, as well as Social Security. And then all retirement decisions, one of the most important roles of a financial planner is to help you manage your taxes through retirement to the extent that you have flexibility or choice. And then we'll leave you with some actionable tips for what is next in your next steps. I love to frame the retirement conversation by talking about a river versus a pond. So I was just talking to a client yesterday discussing their life in the early years of retirement. And in our conversation, the wife described how there was a feeling of some anxiety about pulling from a portfolio in a year when the market was down. And that, the stock market didn't stress her out in previous years because she had been working. And this reminded me of the river versus the pond. When you are working, if you have nice cash flow and a good income, I often think that your financial life and your access to money is like a river. It's always rolling by. You can grab what you need, and hopefully some of it gets put away in savings. And the next week there's another paycheck, and things keep going that way. So access to cash flow is plentiful, bountiful. And there may be bumps along the road, but the river seems to refill and nourish itself seasonally. And so, that mentality is the river will always be there. And there's almost a conversion when it comes to retirement, where now you have a fixed quantity of assets. Perhaps you also have a stream that would be your Social Security income, and for some fortunate clients, a pension. But there is a pool of funds that is non-replenishable. You can't go and recreate your retirement savings after you've kind of hung up your hat in your career. And so it's a different mentality. It can feel more, there can be more, kind of stress and anxiety when it comes to how long will this pond sustain itself, and what happens if something happens to the pond. So I always like to level set with this kind of observation about how a retiree may feel differently about their cash flow. And if we acknowledge that, I think it's very helpful in terms of the conversations about what is sustainable. There are ways to keep your pond healthy. And we as financial planners are both thinking about you being able to maximize your goals in life currently, as well as making sure that we're not kind of stealing from that pond for your future self. So thank you for listening to this analogy and allowing me to kind of set this framework for how we think about retirement and investing. So some important considerations that I think you all have thought of, but maybe not in, kind of a big picture context. Certainly, we can be a little bit morbid as financial planners. Sometimes we talk about the end of your plan, and that really means how long we assume you're going to live. But your life expectancy, it's easy to sort things out if you're not going to live very long into retirement. But we really want to plan for your future self, and knowing that people live longer and longer. People that are in a relationship, the married couple has more propensity to end up, at least one of them, living to a longer age. And so we typically start with an assumed life expectancy between 95 and 100. And of course, we can make adjustments, and we're always looking at what happens if you live longer than that. But your life expectancy is a really important part of retirement. And it goes back to another kind of theme that I want you to understand, which is retirement is a starting line, not a finish line. So I know it is a finish line for your career, but it is a start to a multi-decade process in many cases for how long your money needs to last. We also pay particular attention to your income sources. So one income source that I was just describing with that pond is turning your portfolio into an instrument that pays you a biweekly or monthly paycheck. So that can be an income source, distributions from your investments and retirement accounts. Also, people have Social Security in most cases, and pensions in other cases. So we always like to know and understand those income sources so that we can understand how they work, because some pensions calculate inflation differently. Some don't have inflation at all. So we get into the nuts and bolts of that. You also have to make assumptions about investment returns. And there's a couple factors that go into that. Of course, what's going on in the world. So how markets are, how you are as an investor, and the mix of stocks and bonds that you have in your portfolio. So we always emphasize, and I think an really important action tip for you approaching retirement is to have an investment process that is durable and you plan to use over time. And I think so often people think they're just going to kind of turn off the investing or get extra conservative when they invest, or only rely on dividends. And, we have a preference for using kind of a portfolio model where we take from different areas that have grown when you withdraw from portfolios. But having a process that you don't plan to change the next time the market is down, that will be enduring for that multi-decade retirement, is really important. And the way you decide to invest will be a consideration for the forecast for how your portfolio will behave. Then it's really important, a document that we think is always critical in conversations with clients, but especially around retirement. What assets do you have? And, of course, we're thinking about the cash that you have on hand, your investment accounts, including your retirement accounts, your homes, and other big ticket items that likely have value or equity, but also may have some costs associated with them. So we also analyze the cost associated with owning assets, whether that's taxes, insurance, or maintenance cost. So all of those things factor in as well. And then finally, what will your financial need be over time? And I know there's some age-old rules like, hey, if you just withdraw 4% of your portfolio over time, that'll be sustainable. I really think it's important for people to understand that their financial needs may change over time. I'll get into some of the specifics of that, but you may not turn on your Social Security on the day that you retire, especially if you are an earlier retiree, or you may have different needs earlier in retirement than later. And so mapping out in a realistic way what your needs will be is very important. If you've been someone with a high income where, you put a little bit away, maybe 10% into your 401k, but pretty much spend everything else, it will be really difficult to turn things around and completely change your lifestyle in retirement. So I always encourage people to have a realistic perspective, and especially as you get closer to retirement, understand what you're spending, and some of those expenditures will never change. So being realistic about them. So when this is putting on a financial planner hat, I know that for many of you, you have a 401k or retirement account, and it's a really great feature to be able to plug in, hey, here's your account balance, here's your age, here's how you're invested. You can spend $12,000 a month in retirement. And we think that's a great start, but we like to get very specific on those factors that I just described before. For example, if you still have a mortgage and it will be paid off in 7 years after you retire, we would want to plug in, you're making that mortgage payment for the next 7 years, and then it stops, but your insurance and your taxes continue. We use software that starts with that, kind of plug in what you've got and the rate of return and spit out what you can spend. And we like to get more granular, more specific about your needs to determine what is more realistic. And then in modern financial planning, this is something that has become the dominant kind of perspective over the last 25 years. There's a process where you have to consider the variability of investment returns. So for example, 2 years ago, stocks and bonds were both up significantly. Last year, they were both down significantly, and every year's a little different. So you average out to long-term returns that seem to be, steady out at a rate that is more predictable, but you need a long period of time, and every year is different. And so we take a variety of samples, and we use a term that a European city, Monte Carlo, as our scenario. It's statistical analysis that says, hey, every year is going to be different, and it's better for you if the first years in retirement are the best years for the investment returns, and a little more challenging if the first years in retirement are the worst years for returns. And so we run numbers to see what your probability of success is with that variability. And I always describe it, I have to encourage clients, especially, kind of the eager beavers at the front of the class, that you're not aiming for an A+ on this exam. In fact, in Goldilocks terms, you want to be not too hot and not too cold and just right, in a range that's maybe 80-85% probability of success, because that tells the financial planner that they're not kind of hoarding money away from you and telling you can't spend money that you've worked so hard to save, which if there's a 99% probability of success, you're likely being a little too conservative. And likewise, it's very difficult to recover if you spend too much. And that when you get under 75 or 70 is likely just, there's not enough cushion or flexibility for you to recover with adjustments. So we do this geeky, wonky percentage, but we also talk through actual cash flows with people. And I'm showing you the chart on the top, you can see, and you don't need to worry about these numbers for yourself. We're just kind of giving you a general visual, is like a sample of a probability of success. And then actually on the bottom is tax rates over time for somebody if they just plug in assumptions of spending money in retirement with kind of just, I'll take it from my retirement account first. And you can see that there's like big dips in terms of your tax rate over time potentially. And we as financial planners like to manage taxes over time so we can hopefully reduce kind of those high peaks and maybe, spend a little bit more money when you're in a lower tax bracket, like fill up a 10% bracket. Again, I'm getting super technical and geeky, but these are some of the considerations that we have over time in order to maximize things. There's a lot of little decisions. If you have multiple investment accounts, which account would be best in which year? And how much are you comfortable taking out? Making decisions about your Social Security. If you have a pension, making a decision about, will your spouse get 100% of your pension if something happens to you? And we will put in the technical considerations. And we also ask you, and you should always be thinking about kind of what is your personal perspective and philosophy on some of these decisions. So those all go into it. So I told you that I was going to talk about how you may not spend the same amount over time. And there's a variety of factors, ranging from you may not have as many expenses, you're not buying work attire, etc. But what a theory that was kind of created about retirement spending in the 80s and 90s by financial planners was called the retirement smile. And it describes the go-go years where you spend a lot. Hopefully you're checking off the bucket list, that trip to Europe that takes 3 or 4 weeks is like high on the priority. You want to make sure to do the things you've always dreamed of doing when you have the time to do it. And then perhaps there are slower go years, so you stay closer to home, still relatively healthy. And it's creeping up when those slow go years start, because I think with longevity and people's health, sometimes you can be very active well into your 70s and even 80s. And then, potentially there's increased healthcare costs at the end of life and housing costs that are related and associated with healthcare in what we call the no-go or slow go or no-go years. End of life care can pile on for certain people. And so this was a theory, but what we've consistently seen, and I'm going to use data from Chase, which looks at expenditures for people of similar wealth based on their ages. And then they've anonymized bank data in order to provide this information. You can see that typically people of similar wealth ranges of $1 to $3 million peak out as spending in their 50s and perhaps 60s. The kids are going to college, you still have a mortgage, you're doing the big things and have an income associated with it. As people approach retirement, actually their spending tends to condense and they tend to spend less. You'll see the education yellow line is kind of withering out. Maybe you're paying a little extra help for the grandkids' college, but not for your kids. And then it picks up toward the end of life, primarily in housing and healthcare. So housing kind of has a divot and then picks back up, because even though people think about downsizing, sometimes those ranches with some extra help in the community or active retirement communities tend to carry some additional costs. So, we still work really hard to adjust a retirement plan for inflation, knowing that costs go up over time. But we also talk to you about the realities of spending, can demonstrate to you, if you spent this way, what would things look like in retirement? And I think it's really important to talk about not just, what you're spending as a bucket, but what you're going to spend money on over time. And I think, thinking about qualitatively, what is your life going to look like over the years during retirement is an important factor that a lot of financial planners miss. But, who are you going to live close to? If you need a ride in your later years and you're not able to drive yourself, who will take you to get an ice cream or take you to the doctor's appointments? And so just looking at graphs like this, and certainly we'll provide a replay so you can check it out more when you're not listening, I think is an important part of the discussion. Okay, I'm going to talk some more at the end, but I want to hand it off. Jay, thanks for joining us.
Thank you very much, Melissa. And thank you everyone for tuning in today. We really appreciate your time and attention. And I think Melissa did a fantastic job touching on some of the considerations in retirement. And I absolutely love the analogy of stream and pond. And I know that Alexa is going to touch on a couple of these other retirement considerations. What I plan to cover today is touching on some of the considerations that we have control over. I will talk about expectations on retirement age, healthcare cost, making that transition from when you're working and drawing a paycheck to when you're paying yourself out of your savings and retirement. I'm going to show you a neat benchmarking tool to use to make sure that you're on track with your savings. And then I plan to talk about the importance of creating an elder life plan. So why don't we get started with expectations? I cannot change the slides myself. Okay, here we go. I think this is very interesting because it represents where expectations and reality meet. As you can see, most American workers expect to retire at age 65, where in reality, most people retire earlier than that, right around 62 years old. Now, there may be a whole host of reasons, but there's a very high correlation to when Medicare kicks in. Also, 65 used to be the full retirement benefit for Social Security. But at any rate, for whatever reason, most people feel that or expect to retire at 65, whereas in reality, it's different. And that can happen for a whole host of reasons. Some that we control, some that are outside of our control, like maybe it's a healthcare issue, or it could be a company specific issue like downsizing or layoffs. Also, in some cases, people are forced to retire because they have to take care of a parent, especially where, if you're in a sandwich situation where you're taking care of children and then also have to take care of parents, that would lead to an early retirement. And of course, there are positive reasons for early retirement as well. But at any rate, this is where fact and expectations meet. And I think it's just another reason why creating a plan is very important, because planning incorporates what if scenarios, right? So with that knowledge of what if then, we have the flexibility and control to do things and to retire on our own terms. So next slide, please. Let's talk about income replacement. Again, where we transition from earning a paycheck from our employers to paying ourselves. So it may be obvious that the more you save, the less you'll have to change your lifestyle or standard of living in retirement. But unfortunately, sometimes we talk to high earners that are not saving in their retirement plans. And then when we look and we see that they really have no other savings, what that tells us is they're basically spending all of what they earn. So in retirement, they're going to have to change their lifestyle. They're going to have to curtail their standard of living, which is pretty difficult. So let's look at this example. Here we're looking at I'm sorry. Thanks. So how do we get to retirement income? In this example, we're looking at an individual that makes $150,000. They save about 6% in their, they do save 6% in their retirement, which is $9,000. So for this individual to maintain their standard of living or lifestyle in retirement, that would require $111,000. So how do we get to that? Well, first of all, that 6% savings is no longer necessary. Also, the income tax goes down dramatically because they don't get the paycheck anymore. And then expenditures are reduced as well. Melissa touched on no longer a need for a wardrobe, also driving expenses, childcare. There are a whole host of things, but those are reduced in retirement as well. We use a replacement value of 74%. So again, the person would need $111,000. Social Security kicks in. So from retirement, this person, to maintain that standard of living or lifestyle, would require $74,500. So as you can see, and again, it may be obvious, but saving early and often can really go a long way towards not having to change your lifestyle or your standard of living that you've grown accustomed to when you are a high earner. So next slide, please. So here's a tool, if you will. This is a great way to benchmark where you're at in terms of your age and your income. This is just a great way to see if you're on track. Just for ease of example, how this works is if you make $100,000 and you're 45 years old, you multiply that $100,000 by 3.6%. So for this person, they should be right around $360,000 in savings. Now, don't worry if you didn't have a chance to calculate your age and income, or if you want to do it for a family member. As Melissa said, we're recording this, so you can refer back to it, or please share it with whomever you like. But I think that the takeaway is this: two things is, this is not personalized, so everybody's circumstances are different. But in this case, if you are way under that $360,000, the time is now to make the considerations, or try to figure out what changes that you could make to increase savings and get closer to that benchmark. And I think it's also important to do this, on an annual basis, just to kind of check in to see where you're at and where you should be. Because as Melissa said, we look at, retirement of 30 to 35 years. And again, we don't want to have to dramatically change our standard of living or the lifestyle that we've grown accustomed to. So next slide, please. All right, so healthcare. Again, Melissa mentioned the retirement smile, and if you remember that yellow triangle there, unlike spending in retirement, that goes down over time. And of course, we want our go-go years to be very many and plentiful and well earned, right? But the fact of the matter is, the spending does decrease throughout retirement, whereas healthcare costs increase, and particularly as we get older and require additional care and more expensive care, healthcare costs can increase dramatically. And of course, we're not looking at the influence of long-term care planning, or if healthcare requires really expensive prescriptions. We're just using averages here. But nonetheless, the averages are pretty dramatic. If we're looking at a 65-year-old today who spends just about $500 a month in healthcare, if we fast forward 30 years from now, that's almost tripling in cost, from $500 to about $1,500, again, 30 years from now. So two takeaways I think are pretty important is that one is that we maintain healthcare costs separately from all other expenses because of the rate of increase in healthcare at around 6% to be conservative in terms of the growth of healthcare costs. And the other thing I'd like to point out, and I think is very important, is just like anything, the earlier you can address this issue, the better. So if you're around 50 years old and you start looking at long-term care plans while you're healthy, that can make a very dramatic effect, versus if you start looking at these when you're 60, 65, obviously older, but probably not in as good a health as you would be when you're 50 years old. So next slide, please. So on to elder care plan. This is probably one of the most difficult or personal things, because no one wants to be reliant on others, right? No one wants to be a burden on their family. But I would bet that myself included, that a lot of people that are tuning in have already cared for a family member or are currently doing it. So it's not a surprise that if you think about the majority of people that provide unpaid elder care, it comes from family members, whether it's an adult child, whether it's an other family member or a spouse. That falls typically on family members. And it might not surprise you also that if you studies show that if you look at all of the time and the resources that are spent on elder care, they're very similar to what you would pay for elder care. I'm not implying that we should all outsource that, because we love our families and we want to help. But I think the point that I'd like to make here is creating a plan beforehand, just like we create a plan, we have wills and we have trust in estate planning. I think that elder care is very, very important to do, because we know going in, we understand, we have expectations, we know what the wishes of everyone will be when elder care is needed. So thank you all for your time and attention, and a very special thank you to our clients who allow us to serve them. And with that, I am going to turn it over to Alexa to talk about taxes and Social Security.
Thanks, Jay. I'm excited to share my part, because I get to talk about two of my favorite things, HSAs and Roth IRAs. So we'll get to those soon. But first, we'll talk about Social Security. And I know if you watch the news or, have just been around, people have concerns about Social Security and what the future looks like. So the good news for most people on the webinar is if there are changes or things that come about with regards to Social Security, yours likely will not be impacted. It will more come down to people my age and the younger generations to absorb those changes. So with Social Security, if you're born after 1960, your full retirement age would be 67. And at that time, you're eligible for 100% of your benefit. If you take your benefits at age 62, you're taking about a 30% cut on those benefits. And on the flip side, if you decide to wait for each year, you get an increase of 8% to age 70. So you're not locked into those three ages or dates at any time on the line. You can say, I'm ready for it and start claiming. This first chart shows the break-even age of picking different strategies. So we used to say, if you tell me how long you'll live, I'll tell you when to take Social Security. If we look at it, between 77 and 81 is kind of the break even. And as Melissa mentioned, those probabilities of one or both spouses living to the various ages are on that little chart at the bottom. The one thing we know is if you're retired and decide not to take Social Security, the money has to come from your pond. So the next slide takes it a step further and says, okay, on the bottom, here's how long I'm going to live. And on the side, here's how much, here's the rate of return that my assets are going to get. So it just adds in that layer of, if I'm going to be getting 8% on my assets, what does that look like if I live to age 90 and, just a little bit further than the first example. But the reality is we can't predict the rate of return that your portfolio will get. And we have no idea how long you'll live. Hopefully we're at 100 and we're here to celebrate together. So when we're doing our planning, we not only look at, family history, longevity, that stuff. We look at your assets, we look at taxes, and we also look at you as a person and how you're feeling, what your actual needs are. So Melissa talked about meeting with that client yesterday, and in running the numbers, we're at a 90% here and 88% here. And the anxiety of, my pond is shrinking. And that's where the human element comes in of, you're going to be fine at the end of the day if you're able to sleep at night and, feel comfortable in your financial plan. Like, here's the green light to do what gives you peace of mind in a well thought out and planned way. So we could tell you exactly if we knew these two things, but the reality is we can't quite do that. So Melissa said there would be some action items. So I have homework for everyone is to log in to ssa.gov and pull a current statement. It will show you, what it looks like at 62, full retirement age, and at age 70. You can also look at the history of your earnings record. So Social Security is based on your 35 best earning years. You want to go in and make sure that all the money that you have been earning is accounted for in there, especially before you start to filing. So if there's a problem, get it taken care of right away. I know I got an email this morning from them that said, hey, check your your record. So once you're in the system, it should be pretty easy to keep going on that. So if we go to the next slide, this is just a pretty basic chart that shows the different types of accounts and their attributes. So most people are familiar with and are often contributing to either their 401k, 403b, or a traditional IRA. And we know that our contributions to those accounts are tax deductible, and then those accounts grow tax deferred. And where it doesn't get a purple circle or a gold star is that when we get to the end and we are taking money from the accounts, we do have to pay taxes on those withdrawals. One of my favorites, the Roth IRA, 401k, you do not get a deduction when you're adding money there. It does grow tax deferred. And then when you go to take the money out, if it's a qualified withdrawal, you get those tax-free. So I love Roth IRAs. I have my whole life. And if we go to the bottom, what's even better than a Roth is a health savings account. So when you make contributions, they're tax deductible contributions. The growth in these accounts is tax deferred. And when you take funds out, they are tax-free if used for qualified healthcare expenses. Can you go to the next one? So the chart on the left shows if you're doing a family contribution with the catch-up, it's growing at about 6.25%, and you're in the 24% tax bracket. The dark teal is what you've added. The light teal is that tax deferred earnings. And then the purple is the savings on taxes from using this strategy. So two things, if you have the qualified health, high deductible health plan, and you're eligible to contribute, definitely look at opening and funding an account to really maximize the health savings account. If you're able to contribute and let that account grow rather than paying your doctor bills and for prescriptions from that, that's a great strategy. But we have to remember to invest it, because if it's just sitting in cash, we're not getting that light teal sliver in there. And most HSAs allow you to start investing once the account gets to either $1,000 or $2,000, depending on the provider. So if we're going through and doing these steps to kind of maximize our retirement, we definitely want to make sure we're doing the final step of investing. I know there was a study, and it was, I wish I remembered the percentage, but of the people that contribute to Roth IRAs, like a large percentage weren't investing it, so weren't getting the full optimization of the account. So that's your second piece of homework. And then we can go to the next one. And this just goes back to kind of the Roth versus traditional savings conversation. So a lot of the time when you're young and starting out working, adding to either a Roth IRA or a Roth 401k is a good option because you're in a lower tax bracket. But as your income grows, the conversation shifts to, should I be going traditional to get the tax savings, or should I continue going to this bucket? So it goes to the conversations of, when do I make the switch? And then usually towards the end of the plan, you're in the the stage of adding to the traditional or the the IRA. And this chart also shows where the cliff is your retirement. And I think the most fun part of our job is planning in these years of, we have a lot of opportunities to do Roth conversions and kind of flatten out that tax curve Melissa showed in the beginning. So there's really a lot of opportunities in there to say, okay, are we able to efficiently move some money from a tax deferred asset to a tax-free asset? This will lower the required minimum distributions down the road. And also, if we're looking at giving to our children, the Roth IRA is definitely the preferred asset for kids on that. And then these slides are pretty quick and nothing too crazy. It's just the updated 2023 numbers. So the changes to the income tax thresholds. We see the COLA adjustment for Social Security, and also for the people born before 1960, it has what your full retirement age is in there. Just a lot to keep track of. And then this side of it has the contribution limits for 2023. And these did also increase as well. So if you are maxing your 401k, just make sure that you are maxing to the new limits and not the 2022 limits. Also, if you're over age 50, don't forget about the catch-up contributions. And I also did not forget about our self-employed people. So if you're self-employed, there are options to save money for retirement and also save on taxes beyond a traditional IRA. So depending on your business and your current situation, we can definitely look at what option makes the most sense for you. If you've seen the slide before, there's 2 additions from the Secure Act 2.0, and that's the optionality for a SEP Roth and a simple Roth contribution. So the same kind of trade-offs apply in that, and it's just another consideration that gives self-employed people more flexibility to save for retirement. And my last slide is about a little more about the Secure Act 2.0. So to save everyone some time and not go through everything from there, we kind of just pulled the things that really apply to people at or near that retirement age. Definitely the biggest one is the change in the required minimum distribution age. So that started out at 70 and a half, moved to 72, and will further be pushed to age 75. So that gives us definitely more time to do that proactive planning, because it's giving us more time from your retirement date to when the required minimum distributions come in, because those can definitely increase your taxes after several years of low taxes. One thing on that I wanted to note is that if you are charitably inclined, the qualified charitable distributions, which allow you to give directly from your IRA to a qualifying charity, and you avoid paying taxes on that, the age that you're able to start doing qualified charitable distributions has stayed at 70 and a half. So even though the RMDs don't kick in until later, depending on what year you were born, you may still be able to use that to give to the charities of your choice. The next one is the penalty for missed RMDs has gone from 50% to 25% and could further be decreased to 10% if you pay it in a timely manner. We would just recommend not running into that situation because it's paperwork and stressful, but it is a change there. The next one is that starting in 2024, the $1,000 catch-up contributions on IRAs and Roth IRAs will be indexed for inflation. And then the change to the Roth rule is if you have a Roth IRA, those are not required to have a required minimum distribution. But if you had assets in a Roth 401k, those assets were subject to a required minimum distribution. But starting in 2024, the Roth portion for 401k plans is not subject to an RMD. And then the last thing is just there are more exceptions and flexibility on the 10% early withdrawal penalty. It's good to see the flexibility there for people that have been affected by natural disasters, family emergencies. And there's also a stipulation in there that allows people to take up to $2,500 a year for qualifying long-term care plans. So Jay should be happy about that one. So there's a lot more in the Secure Act 2.0, and I know Melissa Joy and Melissa Fradenburg did a nice podcast episode about that earlier this year.
Wow, we're flying through a ton of details. I'm surprised we're able to fit it into an hour. And I got already great Q&A comments about HSAs, because one of the reminders is not everybody is eligible for an HSA. You have to participate in a high deductible plan. And there are trade-offs in terms of the cost of healthcare, depending on your family circumstances and the way you utilize healthcare, prescriptions, et cetera. And so the bottom line, I think it's important to share, is it's complicated. And I'm so glad that we have the opportunity to do, discussions like this that go into the theory and practice of retirement planning. And we've got all of those calculations going in the back of our head all the time. I don't know how someone would do it with a financial planning team of one, because we really make each other better, whether it's, an idea of, hey, should we look at utilizing this strategy or this account? And so when I got into the business 25 years ago, there was like $2,000 you could put into an IRA or a Roth, and the rules felt a lot less complex. It continues to add on, which is both a challenge as well as an opportunity. This is like just a little plug on some of the advantages of working with a financial planner. I really think that there are some people that are set up great to be do-it-yourself investors, but not everyone. And depending on the phase in life that you're at, your needs may change as well. When I work with someone who is in an accumulation phase, so mid-career, what we're really trying to do is continue to have that expenditure that we saw in, that enjoying high earning, high income and meeting the needs of a family, or perhaps being in a sandwich generation where you need extra care for your parents as well as your kids. But also make sure that in those like fat years for earning, you're able to put some money aside in your pond, take from the river and put into the pond. When I get to people who are approaching retirement, you really need to see, I know I can trust you, but what exactly is my paycheck going to look like? What account are we pulling from and when? Who can I help make my Medicare decisions for me, or whatever your healthcare situation is? And, we need to refresh and update your financial plan each year to make sure your withdrawal rate remains sustainable. And then when we work with people during retirement, again, the needs change. In early years, you're making sure that things work and make sense. And then in later years, you are making sure that you're staying on top of things, because at a certain point in time, for many people, there may be just a need for some extra help. You may have been working as a team in a relationship, and if one of you is less able to contribute, and perhaps that person was kind of the quarterback when it came to the finances, there's a variety of circumstances where it's helpful to have a professional on board. So our work with people changes over time based on your specific life, and the variability. Everybody is not the same when it comes to retirement. But those needs and the attention to detail in these areas is important, whether you're kind of implementing and executing on your retirement game plan yourself or using the work of a firm like ours. I do want to leave a little space for Q&A. So thank you for those who have mentioned, an HSA, for example, it may be right one year and not right another, and not every employer plan has it. And like I said, I know there are trade-offs. If you work for University of Michigan, you can't do an HSA option. They don't have high deductible plans, but they also, if you put in the right number of years, have a reduced retirement cost because there's some extra healthcare costs that are built in. So there's all these like little granular considerations. I thought I would also leave you with 6 important things. You can jot them down or listen back. 6 things that you really need to have on point as you retire and into retirement. And so you can be thinking about them early if you're Gen X and retirement's a long way away, but more real than it used to be. It sounds really good to hang up your hat at work, or even if you're planning for early retirement. One thing I would make sure first and foremost is have your purpose first, then your plan, and then your portfolio. So many times, financial advisors are just like, show me your accounts, I'll manage them. And really, I think planning done right is, hey, what's the point? And, that can just be like, hey, replace my paychecks. I just don't want to worry about money, or it may be, some really important goals that you have. Make a plan for it and then execute on that plan and then get to the investing side of things. It seems seamless when we're working on it with people, but we really start with you and then get to your money eventually. And that's the whole point. Number 2, understand your time frame. When you retire, it feels like I said, sometimes it feels like a finish line. And in a way it is, but it's also a starting point for a multi-decade game plan. And sometimes I have clients come to me and say, no, I'm dying in 10 years. Like, don't worry about me after that. I just can't do that as a professional. And I want to remind you that it is a long time that you'll be managing that portfolio and investing, which leads me into the next point. And Jay touched on this: plan for the unexpected. Whether it's a pandemic that shuts down the world that no one has ever experienced before, or a personal change or challenge, or maybe a personal windfall or opportunity. Life changes, there are pivots in the road. But if you can circle back to that plan then and say, because you have one, and say, how have things changed? Jay described reasons why people retire early. Well, it's great to get back to the plan and say, here's how we would have to adjust versus like, let's get started right now. And I know people like carry that, like something could go wrong, or I'm not sure how I'm doing, as anxiety in many cases. I hear that when we start working with people. Use your financial planner or, your investment and discipline on your own retirement plan, if you're doing it yourself, to alleviate that anxiety. Don't live with it, because that can both reduce your health, increase and, reduce kind of your quality of life. Number 4, have an enduring investment process that you're going to stick with. So don't plan to change everything midway, and have a process that includes, bear markets and down markets, because over a 30-year period, there's going to be more than one. And, also doesn't change when everything's aiming for the moon. Number 5, carefully consider withdrawal plan. It has important tax considerations, as well as, you need to make sure that your withdrawals are sustainable. We have done hundreds of plans for people of a variety of ages, and then refresh them each year to understand the nuances of withdrawals and know what is the right amount, that Goldilocks kind of range, and what is too much or too little. And then number 6, and finally, do consider, does it make sense to work with a financial planner for a variety of considerations or not? And then be comfortable and confident in that decision. What I see, if done right, the advantages to working with a financial planner and continuing to work with one, because I know that many of you listening live on the call are people we work with already, is that you pick up opportunities along the way. And we're also thinking behind the scenes, there's a lot of nuances to the Secure Act, and frankly, it adds a lot of complexity. Not everyone is going to be impacted, but yesterday we talked to someone who is 71, turning 72 this year. And oh, heads up, you don't have to do required distribution next year like you've been planning, or this year. It will wait until you're age 73 because the rule changed 5 weeks ago. So, some of those things, the picking up things along the way, both opportunities and avoiding pitfalls, is kind of how I see the compounding kind of good returns of financial planning. It's been great to get a chance to spend time on this topic that I think we could do a course on instead of an hour. But please follow up with us with questions, or if you have any comments, concerns, or things that would be helpful for us to clarify. I don't see any other questions right now. So with that, I'm going to let you go, and we'll have a replay up on the website in 4 or 5 days, and make sure to send this call as follow up, the replay, to you as well. So thanks so much for listening, and have a great day.